Summary of Chapter 1. First, we covered three main questions of corporate finance. First, capital structure. Capital structure refers to how much money is borrowed and how much money is not borrowed, or equity. So, should we borrow? Should it be 50% borrowed, 50% not borrowed? Should it be primarily money that is not borrowed that the firm is using for its businesses? That's all part of capital structure. Question 2, working capital management. This has to do with planning money to be invested for short-term activities of a firm. Managing everyday activities, things like how much cash should be set aside to cover any unforeseen expenses, how much to sell on credit, paying money to suppliers, should it be paid on credit or paid in cash. And the third question is capital budgeting. This also has to do with investing money, but rather than for a short term, which is a period of time under 1 year, it's for a long term, which is anything longer than 1 year. So in other words, planning long-term investment activities. For example, maybe an example of such activity is expanding business. Let's say a restaurant chain would like to open a new location somewhere in the area. That new restaurant would be a long-term project because it would be bringing money over possibly many years. The main thing that's covered in this area of corporate finance is evaluating an investment opportunity, a long-term investment opportunity. Is it worth investing money into it or not? It's worth it if the money we invest today is less than the total amount of money that we would receive back in all future years. Then the chapter looked at three main forms of business organization in the USA. The three main forms are sole proprietorship, where you are a single owner, a partnership, where there are at least two people who share in profits, and a corporation, which may have millions of owners. For each, we looked at what those are and advantages and disadvantages. The main disadvantage for some of these business forms is called an unlimited liability for business debts. That's when, let's say, you're sued, your business is sued, and you don't have enough money to cover the costs, and you are liable for covering the full cost of the lawsuit, for example. And for that, you may need to sell your personal assets, such as your house, your car, and so on. That's an unlimited liability for business debts. In which of these three forms of business organization do we see it? Sole proprietorship, and within partnership, it's for so-called general partners. There may be general partners and limited partners. General partners face this risk. Limited partners, they do not. They have a limited liability for business debts. And the most they lose is the money they brought in when the partnership was started. In a corporation, all owners, which are stockholders, there may be millions of them, they all face a limited liability. Then in the corporate form, there is something called the agency problem. Because unlike sole proprietorship and partnership, where the business owner or owners are also the ones who run the business, in a corporation, it's separated into two different groups of people. Those who own it, stockholders, and those who run the business, the managers. The agency problem is a conflict of interests between these two groups. We looked at more details on it, some examples, and how it could be resolved. And the last part of the chapter was on financial markets. This is a general term describing where and how financial securities that a corporation may issue to raise cash such as stock shares and corporate bonds, where they are traded. um, there is something called the primary and the secondary market, where, for example, stocks may be traded. A primary market is where when stocks are sold by the company for the very first time and investors buy those shares. The secondary market is everything that follows from that point on. So investors start selling shares, new investors buy those shares. In other words, stocks start switching hands. This is all called secondary markets. How can stocks be traded? How is the price determined? They can be traded in an auction setting by brokers who represent, you know, who participate in the auctions, such as New York Stock Exchange, on behalf of their clients. And also, stocks can be traded by dealers who buy shares and then try to sell them for a profit and make money on the price difference. So the dealer market example is NASDAQ, National Association of Security Dealers Automated Quotations.